Hey, Kevin here, top 100 financial advisor and best-selling author, and we are here to talk about the stock market. We got to talk about this viral Dave Ramsey post and what the issues are with it. There are some people that just do not like Dave Ramsey for a lot of valid reasons, and then you've got people that totally agree but don't really know the inner workings and or the problems with this particular post. So let's break it down. I'll react to it. I'll keep the post on the screen as we kind of go through and break some of this stuff down and correct errors, but also say, hey, these are the things that actually make sense, and kind of we'll start from the top and go down. All right, so he says invest in mutual funds, and he says spread it across 4 categories: growth and income, aggressive growth, and international. That's fine. I don't have the biggest issue with that. What I do have the biggest issue is he singles out that you should invest in mutual funds. But if you go down to the bottom of the list, he says do not invest in ETFs, which is strange to me. ETFs stand for exchange traded funds. I believe we did a video on that. And they are cousins to ETFs, but they have some really specific advantages that are better than mutual funds. So for example, you can look this up on Vanguard as well. But for example, one mutual fund, I'll pull up a ticker symbol so I don't get it wrong, is VT, ticker symbol VTSAX. That's a total stock market index fund for Vanguard. That's one of them. They have multiple ones, but this is just one of them. The counterpart to that, the ETF version, is VTIs, one I talk about all the time. Now, these perform in the exact same way because they do the exact same things. They track the overall performance. Every stock is in this mutual fund. Every stock is inside that ETF. Here's the problem, though. For mutual funds, for most mutual funds, number one, they tend to be a bit more expensive. In Vanguard's case, the difference is negligible. It's not that much. But in other cases where it's not managed by Vanguard, it could be significantly more expensive. But, and so when I say expensive, I'm talking about in terms of fees. So significantly more expensive in terms of fees. Also, there are a lot of minimums that can come with a mutual fund versus an ETF. So if I'm someone who is just starting out, maybe I'm investing my first $500, my first $100, my first $1,000, you may not have enough to invest in a mutual fund where you can get that exact same performance at any dollar level with an ETF. So for example, in the case of this Vanguard Total Stock Market Mutual Fund, you have to have a $3,000 minimum. If you don't have that, you're sitting on the sidelines watching the market pass you by. The last I checked, which was last week before the dip, the stock market was already up 25%. So if you're saving that first $1,000, you're saving that first $2,000, you have missed out on 25% growth. If you had just went with the ETF, you could have captured some of that and got you closer to your financial goals as opposed to just waiting around to hit that first minimum. That doesn't make any sense to me. I don't know why you would say don't invest in ETFs but invest in mutual funds when in this case and in most cases the ETF is going to get you the exact same performance as a mutual fund. There's nothing inherently bad about ETFs, and I have no idea why anybody worth anything would say don't invest in ETFs. That's dumb. So that's number one. The second one, let me pull the post up here so I can look at that as well, is real estate paid in full. Not a huge fan of that. I actually did an article. I will post that as well, and then we'll get back to the post in a second. But I actually did an analysis on my own home that I just bought this year. In terms of investment, if you're talking about your primary home, which means we're not talking about multifamily rentals, we're not talking about Airbnb half of your house or something like that. We're not talking about that. We're saying you buy the house that you live in 30 years, would you have made more money owning the home or investing that money in the market? And in most cases, you don't make as much money as what you think you do. So there's that. But also he's saying that you should really pay for the real estate in full. There's a few issues there. Number one, as of today, interest rates are really low. So that means, I think my interest rate, and I actually talked about in the article, is like 3%, less than 3%. And while the market is not guaranteed, we know the market is going to average 8, 9, maybe even 10%. So I am paying extra to pay off an asset, right? At 3% guaranteed. I'm guaranteed to pay it off at 3%. and not invest more in the market, which is not guaranteed but does average well over what the interest rate is for the house. So if I'm getting more bang for my buck, I should be really investing, paying off the debt, right, and investing that money. Now if we're talking credit card debt, different story. Credit card debt can average 15, 16, 17%, if not more. But if I'm, why force myself to pay off my home when the interest rate is really, really small, where I can take that money and invest it in other places and get a higher return and have a higher net worth at the end of the day? To focus to pay off your mortgage debt doesn't really do as much as what you think in terms of net worth and overall wealth. So that doesn't, mathematically, the math ain't mathing. The math here doesn't make sense. So I don't agree with mutual funds. They're not the worst thing in the world, but if you are starting out and you're trying to build your way up, ETFs are just simpler and usually cheaper. So that doesn't make sense. The math case for real estate is real strange. But let's say if you're investing, right? If I'm doing a rental property, how much money do I just have to buy a whole rental property outright and pay it off in full? Like, that's a little more difficult. It's not how the average person does it. We can discuss whether or not average is good, but what have you. So don't agree with that. Then it says don't invest in single stocks. That's if you don't invest in single stocks and you're only doing index funds, you're only doing ETFs, that's fine. You don't have to do single stocks. You don't have to at all. I think Microsoft is a great company. I think Nvidia is a great company now, but you don't have to own that. Now, I may get more money than you because I know that Microsoft is up 50% in the last year and these index funds are not, but I am taking on more risk. So you don't have to invest in single stocks. I'm actually not that upset about it. He said don't invest in Bitcoin or any cryptocurrencies. I'm not a fan of that, and this is the first thing I kind of circled in terms of, like, you might not know what you're talking about, in that your advice has to change and be tailored. Because, and I wrote about this, I'll put that article here too, from CNBC last week, where I actually talked about how finance changes so often and that you have to update your advice and your recommendations based on what's happening right now. Now, you can go back and check the video and stuff I did in 2017, 2018 when Bitcoin really hit the mainstream. And I said back then, if you don't understand Bitcoin, don't invest in Bitcoin. If you just heard of Bitcoin, it's the only thing that you have, and you don't have any stocks and you don't have any ETFs, don't invest in Bitcoin. That's not your space, right? As I learned more, as the world learned more, I updated my recommendation and said, hey, look, 5%, up to 5% of your portfolio in Bitcoin makes sense if you know about the risk. Now, you do not have to invest in Bitcoin. I do, right? You don't have to, but I think from 1 to 5%, that makes sense. That goes in line with a lot of financial professionals. I waited until I saw a Morgan Stanley, a Goldman Sachs start to allow their investors and their funds to own it in some capacity. I said, okay, look, I've done the research. I've waited and understood what's going on. Let me update my personal stance and let me update what my recommendations would be. I didn't, stay under a rock and just refuse to see what is right in front of me. I'm not a fan, right, of a lot of these meme coins. I'm not a fan of Dogecoin, not a fan of Shiba Inu, and a lot of these random ones that just pop up out of nowhere. However, if they were to become legitimate, which means you have to do it for years and not just, a joke, then I would update that. But I wouldn't just say don't invest in any Bitcoin ever, which is pretty much what this is saying. Just don't invest in Bitcoin and just leave it alone. You gotta stay up to date with the times, and I think Bitcoin has been around long enough for us to understand. And once you start to see a lot of institutional support, which we have seen, we got a Bitcoin futures ETF now. Come on, man. Like, it's here now. It's here now, right? So for me to say just no cryptocurrencies and no Bitcoin at all doesn't really make sense. It is not required. You do not need it. But I mean, 1%, 2% at least. Like, I think that would make sense, but not required. Moving on. Whole life insurance policies. Now, I actually agree with this in some capacity. Now, I did a whole semi-viral post on Instagram about whole life insurance as an investment. For most people, it doesn't make sense. There are a few cases where whole life insurance makes sense. If you have a child that has special needs, it could make sense. If you have a business partner, it could also make sense because you would have life insurance policies on each other. Something happens to one, you use the life insurance policy, cash out the business, and things can continue to roll forward. So in those cases, those are just two cases that it makes sense. A third case, the whole life insurance makes sense, could be where you've already maxed out on your 401k, your IRAs, you already have a taxable investment account, and you have extra money laying around. Then a whole life insurance policy can make sense too. It should not be your main investment. I don't think life insurance should be an investment at all. However, those are the few niche cases that make sense. Most people don't need it. I'm okay with having this in the don't invest in category. And that's probably one of the few things I actually agree with, I would say 95% of the time, because there are a few cases where it makes sense. Notice I said whole life insurance, and the list says whole life insurance and not term or just life insurance, period. Some people don't read, some people don't listen and say that I don't like life insurance. I ain't want to say it. I said I don't like whole life insurance for most people, not all. So life insurance, you can have that, that's fine. Annuities, that's also fine. I'm not gonna take a huge beef with that. Annuities, they're semi-insurance products where basically you give money to the insurance company and they will pay you. They'll take that money, they'll invest it on their own and pay you a set amount in most cases for the rest of your life. That's the cool thing about annuities. They can be very expensive. They can be very, very complex. A lot of these old school people do not like annuities at all. They've gotten a bad rap. There are some places for it. But for most of us, you probably don't want an annuity. And that's fine. That is fine for now. I'm not going to hate that one as much. Then we got bonds. Don't invest in bonds. I don't know, man. There are some decent bond funds. The older you get, the more bonds you want to have. These kind of balance out a lot of the market volatility. The way that I do it sometimes is we talk about the rule of 110. Some people are updating this to rule of 120, where you take 110 minus your age. That's the percentage you should have in stocks. The rest of it you should have in bonds. You can be as conservative as you want with bonds. I wouldn't put it in the don't invest in category, but it's not going to be my main investment either based on my age. Now, if I'm older, I would probably have some more bonds because I don't want to have to be beholden to the stock market all the time. For example, and I don't think I explained this, bonds are basically loans that you make to a city, a company, a state. You are guaranteed to get that money back so long as the company still exists or the state or the U.S. government is still, collecting taxes, which in most cases is going to be the case. U.S. government bonds are considered to be the safest asset out there, unless you don't raise the debt ceiling and the entire U.S. economy collapses, which hasn't happened before, but we got close. And we might get close in December too. They keep playing. But aside from that, they don't pay much. U.S. bonds don't pay much, but as you kind of move away from those, municipal bonds from like the city or state of New York, those are state bonds. The city has municipal bonds. I do a whole video on that. I would put it in the don't invest category, but most people don't invest in individual bonds. They do bond ETFs like ticker symbol BND. It's a Vanguard Total Bond Market Index. It's not going to make you a ton of money, but again, it's a little less risk than the market as a whole. So there's that one. Micro investing. So these are like some of these sites where you get to loan people money and you get money back, but you do it as a group. I forget one of the most popular ones. Like I don't know if Cabbage is one of those or not. But in any case, that's fine. I'm not gonna hate on that one. People have made money. I know people have made money that way, but just not a space I invest in. But that's fine. Then you've got, and this is all in one category, you got REITs, real estate investment trust, ETFs. I covered those, and then CDs. I don't know why you would put REITs in this category. REITs have been shown to be quite solid. One of my favorites is AMT, American Towers REIT. REITs pay decent dividends. They usually have solid growth. I don't know why you would put REITs in the don't invest category. That doesn't make sense. ETFs definitely don't make sense. CDs, to a degree, make some sense. The reason why it makes sense, CDs are certificates of deposit, basically the way they used to work, and they still work to a degree to this day is where you take your money, you give it to the bank and say, look, you're going to lock it up for 6 months. You're going to lock it up for a year. I can't touch it, but you're going to promise me a higher interest rate. Back in the day, this was a good investment because it was guaranteed. Today, you're not going to get that much interest. I don't want to really tie up my money. I want to go more for a high yield savings account, which means that I can withdraw the money when I need to, and I'm getting a higher interest rate. But today, interest rates really ain't paying you much of anything anyway. If I had to choose, I'd go for a bond. if I had to choose something that's lower risk, and still get paid. So I'm okay with CDs being here at this point in life, in the economy. You don't want to say I'm investing in a CD. You can have a CD. Let's say you're saving for a home. You got a vacation coming up, I don't know, in a year. Maybe you're saving for the Olympics or something. I don't know. And you know you have it. You know you want to lock it up so you can't touch it. Then fine. But I really wouldn't consider it an investment. And definitely not the best investment. So, I mean, that is my rundown. That is my take on it. Really, the mutual fund thing is a red flag that I cannot make sense. I cannot justify why you would say invest in mutual funds but not an ETF. That doesn't make any sense. The real estate thing, that's a whole different category. I'm fine with real estate investing. That's fine. But to force yourself to pay it in full, while there are some advantages, is just unrealistic. And may not be the best use of your capital when there are other opportunities for you while you are paying down the debt on a mortgage or rental property and what have you. You can just be more efficient in other ways. Single stocks, again, I'm just kind of quickly running these down. You don't have it. You don't have to have it. I think it makes sense. Same thing with Bitcoin. You don't have to have it. It makes sense. But some can make sense. Whole life, annuities, I'm fine with. Bonds, meh. I'm okay with not micro investing. I wouldn't make it a hard and fast rule, but fine. REITs, ETFs, I don't know why you wouldn't have those. And then CDs, fine. You can have that one. So that's my reaction and take on it. Maybe it wasn't as animated as what some people thought you were going to get. But I wanted to break it down logically. But I would say that this is puzzling. I think he has a brand. He has an identity, and he's definitely catering to that, and that's him. But you do want to just analyze like what he's saying and why. And this does not make sense for most people, but it really doesn't make sense in 2021 and in 2022, especially when you have so many new investors, especially millennials and Gen Z, that are trying to figure out what we do with the money that we are just now making, right? This is not the 80s anymore. This is not the 90s anymore. We have access to start investing at smaller dollar amounts to really make a difference because we're not being paid the same rate as everybody else. And we have student loans. We have a lot of barriers, both systemic and otherwise, that did not exist at that point in time. Therefore, you have to kind of reclaim your wealth and readjust some of your financial picture in a way that wasn't there before. So yeah, crypto has to make sense to some degree. I'm not telling you 90% of your money should be in crypto. Not saying that, but I did adjust, right? I think it does make sense to adjust some things and tweak it to get to where you should be financially and create financial freedom in different ways. Another thing too, and this is from Dr. Hines, I think the average return for Bitcoin is like 170%, something absolutely ridiculous. So imagine you you're forcing yourself to pay off debt at 3%. Notice I didn't say credit card debt. I'm talking about real estate at today's rates at like 3%. I'm forcing myself to pay that off when I could have paid that and invested in something like Bitcoin that would have taken care of everything itself, right? Could have paid off the debt, pay a little bit extra, but also invest in stuff like Microsoft or Nvidia. That would have really, really increased my wealth and kind of taken care of the issues myself or itself, rather than waiting to hit a minimum dollar amount for a mutual fund and then forcing myself to pay off my home at just 3% when that money could be working elsewhere. So not the most efficient strategy, not the most knowledgeable strategy either, but that be Dave. That's how he roll, and it don't make sense. So that's my reaction. Those are my honest thoughts about it. Let me know what you think in the comment from an investing perspective. You hit me with baby steps and how he did that thing. That's not the conversational topic of this particular video. We can get into those thoughts later If you want that video, let me know. All right, I'll talk to y'all later. Bye.